let's kick this off. We're 7 minutes after. Nick, why don't you introduce yourself? You definitely have a novel investing model. How did you come up with it? And just give us a little bit about yourself and how you got started.
Sure. It's great to be here, Daniel. Ashish, thanks for setting this up. Yeah, and I like to start with the story of Vint whenever I'm speaking to groups of people, as you know, it's pretty core to how we structured it and how we operate today. My background is in the investing world. I was at a value investment fund that managed about 20 billion. And I've always been a trader of sorts, whether it was Pokemon cards or players in video games. These inefficient markets were always really interesting to me. So I kind of combined that value investing mindset of finding assets that trade below their intrinsic value with inefficient markets, which led me to wine and spirits, which is a really, really interesting asset class. It has this long track record of strong returns. It's largely uncorrelated to traditional financial markets. And it's a very inefficient market. And by inefficient, I mean economically inefficient. You have pricing disparity across regions, merchants. It's highly fragmented, highly opaque, and the ability to use data to create an edge is certainly prevalent. And I like to contrast that against my old job, which was at a public equities fund. You know, there's so much money allocated to price those, whereas wine and spirits, it's a really, really interesting market. However, prior to Vint, this was about 2019, the only way you could really invest in the asset class was to basically have a seller or work with a UK firm where you could cut a check for 25 grand, and then 3 weeks later you would get a list of wines back. Frankly, I didn't think either of those were very good products, and definitely were not financial products. Opaque, inefficient, largely inaccessible. So we spent about 9 months with the SEC setting up our structure that allows us to curate thematic collections of wines, spirits, wine futures, and securitize them with the SEC, allowing anyone, accredited, non-accredited, institutional, self-directed IRA investors, anybody can buy shares in thematic collections of wines and spirits. So we've been around for about 2 years, raised about 7 million in venture funding. We've done 70 offerings on our platform and have a great team. So that's the backstory. Mission is to create a new asset class where people look at this right next to stocks, bonds, real estate, private equity, land flipping, whatever your portfolio is composed of. So that's Vint, what we're doing, and happy to run through some slides here that talk more about the asset class, and try and educate you all about wine and spirits investing. And feel free to jump in with any questions at any time. All right. Talked about myself. This asset class, most people don't think of it as a financial asset class, and I think that's one of the things that we're trying to flip in terms of how people think about it. I could walk down the street, talk to 100 people, and ask them, "Have you ever heard of wine investing?" And maybe 5 people will say, "Yeah, I've heard of that." But if I reframe that as, "Have you ever heard of people collecting wine, having a wine cellar?" The majority of people have heard of that. And what they don't realize is that there's people who have the cellar who collect this asset. A lot of times they may buy a case of wine, sell 9 of the bottles, drink the other 3 effectively for free. And for us, that's really interesting. And then taking that concept and financializing it. And it's clear that investors have been allocating to collectibles like wine and spirits. Credit Suisse ran this survey, and a few other banks have done research around collectibles. And it is, a material part of a lot of ultra high net worth investors' portfolios. But the barriers to entry have been really high from a knowledge perspective, from a capital expenditure perspective, such that it really is an exclusive group of individuals who have access to the asset class. And a funny note is that you think about our platform, it's really not actually the wine connoisseur who is the customer. A lot of these people don't love opening up the asset class to all investors, but that's what we're doing. The longest running study of fine wine returns was done by Cambridge. So Cambridge ran a study dating back. Just happened. Dating back to 1900, where they studied fine wine, art, stamps, equities, bills, and looked at particularly auction pricing for wine, and showed this 8.5% annual return, outperforming a lot of these asset classes other than equities, with a pretty low correlation across the board. Looking at whiskey, its history is not as long in terms of studies dating back to 1900. However, it has been a really strong performer. One of the indices that we look at is the Rare Whiskey 101, and then also the Knight Frank Wealth Report, which you may be familiar with. They look at where are people sort of investing in terms of luxury assets, and whiskey over the last 10 years has been one of the strongest performers. I mentioned lack of correlation, and I think when people think about diversification, it's like, well, I'll own stocks, bonds. Maybe that's probably not how you all think with these weekly webinars, but I think the biggest test of correlation is when things go bad. How does the asset class correlate to traditional financial assets? Looking at 2001 dot-com bubble, wine was up about 10%. Looking at 2008, wine was basically flat. And then recently, in the current environment and the volatility and the lack of performance last year, especially from the 60-40 portfolio, wine has continued to outperform. In terms of how does the macro environment impact wine and spirits as an asset class? Rising interest rates, obviously a big topic of conversation right now, and as well as inflation. And what we see from investors is there's this flight to a store of value in both of these types of environments, particularly when sentiment around the US dollar is weak. They're looking for something like gold, something like fine wine as a flight to safety asset. And that Cambridge study that I mentioned shows that wine as an asset class has about 2x inflation, offering a strong hedge in inflationary environments. This is a look at some of the other traditional financial assets, commodities, and in terms of recent performance. One thing that we've observed is that we like to quote the longest term historical track record for me, value investor at heart. Like we look over a long horizon, and that's the view that we take when thinking about this asset class. But the more that we compress this asset class in terms of the last 15, the last 10, the last 5 years, we have seen returns increasing. And for us, our view is that we're still in the early innings of people, thinking about this as a financial asset class, but with education and content that's out there. Specifically, right now, I think a lot of investors are looking at their portfolio, especially if they were a 60-40 type of investor, and with last year's performance, looking for alternatives. And I think a big driver to people looking at wine and spirits as an asset class, and frankly, a lot of other alternatives, like you've seen KKR put out a piece recommending a 40-30-30 portfolio. JP Morgan, Goldman, all having similar commentary around the 60-40 portfolio, is that when people lose money, that hurts. Loss aversion is a very, very powerful phenomenon. And when this last year you had people lose money, they're less happy with their financial advisor. They're looking for ways to make sure this doesn't happen. So you're seeing this pull forward of alternative assets. And I think distribution platforms like an iCapital are certainly helping this. So thinking about what does wine and spirits really correlate with, and for me, when I think about portfolio construction, a lot of it is grounded in modern portfolio theory, Harry Markowitz, trying to find these uncorrelated asset classes that offer not only stronger returns, but lower risk associated with those. And the lack of correlation is the most important part of that. Wine and spirits is not correlated with traditional financial macro factors like interest rates. A lot of it is driven by scoring data, production data, weather. And then one of our investors is actually a professor at Stanford who's done a lot of work in the wine and art space, and finds that the strongest correlating factor to this asset class is the overall wealth of the world, and in particular the top 1% there, and that continues to appreciate. They continue to buy these assets, and that trend seems to be pretty strong.
Hey, Nick, do you want me to interrupt during the talk and bring questions,
Yeah.
or would you like me to hold them towards the end?
No, that would be great. I actually just opened the chat.
Okay.
It was going to tackle these. So Mario asking, is this set up as a fund? Some of the, good series of questions that happy to cover.
Well, let me read them off to you, and we can kind of have a dialogue going back and forth, because I'm going to start up a little bit higher and say that a lot of people here are very used to real estates, real estate syndications, real estate funds, individually investing in real estate. And so how is the investment set up? Is this a fund where people put their money into and act as a passive investor, and you're constantly buying and selling wine on the back end? Or do you put together a specific selection of wines and spirits for each investor, maybe like kind of more like a syndication would be? What's your model?
Yeah, and that's a great question. So we have two products. We have collections, which are qualified under Regulation A+. And what are those? Those are LLCs that own a series of assets, typically thematic. It could be a single producer, it could be a region, single vintage, or other theme that we find to be interesting. Those sizes are from 25,000 to about 350,000. And those are released weekly on our platform. And the ownership is a membership interest in that LLC. We also have a fund that is going to be similar to your real estate type of fund, structured in that manner, Texas partnership, and we are actively managing that, trading, selling positions as time comes, and we find really interesting opportunities to exit. So the collections, the initial investment is $100. The fund is a $10,000 initial investment, only open to accredited investors.
Okay, great. That's definitely lower than most real estate funds' initial entry fee is, which makes it very interesting for a lot of people. What sort of, if I could jump right to this, what sort of dividend or return do you give
Yeah. So
normally?
yeah, quote the historic
Projected.
8.5% as our benchmark. However, I do view there to be sort of structural advantages with data, with scale. And then the biggest one here is we've gone vertical. So we have the supply relationships that are direct. And then we also have licensure in the US to sell direct to consumer. So there's this structural advantage where there's no transaction costs. So that's the historic returns. What have we done to date? So we've exited 12 collections, and the net IRRs on that is about 31.5% from those exits. That's about, we've had exits from about 20% of the collections. So wouldn't extend that to, the whole breadth, but that's what we've returned to investors thus far.
What does your hold time tend to be for those collections?
Yeah, for those, the average hold time is about a year. We guide towards 2 to 7 years, as this is a medium-term investment. And the way that I think about the returns is that there's an upfront arbitrage. We're using this data. A lot of our collections are sourced at a pretty significant discount to fair market value. I'll use our first fund, which was Rare Whiskey One, which was oversubscribed. The total discount to FMV, and we look at FMV, and I'll give this caveat that this is an alternative asset class, and it's not being traded on a daily, hourly basis like public equities. So how we look at fair market value is taking in US retail market data, UK data, and then auction data. And then that's how we estimate a fair market value. So with the Rare Whiskey offering, we actually we were at a 15% discount to the estimated fair market value. So like encapsulating the returns, you have this upfront arbitrage, you have supply and demand, like Econ 101. It taught me when you have an asset class that has ever decreasing supply, there's no more 2010 Screaming Eagle being produced or 78-year-old Macallan. It's only decreasing supply, and then it's also aging over time, thereby increasing demand. Price should appreciate. So upfront arbitrage, supply and demand, and then on the back end we have that no transaction fee type of exit model where, because we own it and because we have really efficient relationships, we can exit typically above fair market value. The exits that we've returned capital to investors through have been anywhere from 5 to 20% above our estimated FMV.
Interesting. So you mentioned the appreciating price here. One of the benefits of oftentimes of real estate, and I'm sorry that I'm coming to it from this standpoint, that's what a lot of people here do, is depreciation. Are there any sort of depreciation or tax? Maybe tell me about the tax benefits of the fund, I guess.
No, there
Nope.
are.
Yep.
That's
I'm not surprised, but
yep.
but that is to say that it's an asset that's rare and unique, and so it's not like real estate where the reason why you're getting the depreciation is because there's wear and tear on the product. This is a very preserved product over time.
Yes, aging, aging and improving. I guess it's sort of the opposite of real estate.
Right. Okay. other questions from the chat here. How do you find your Mario is asking about how do you find your buyers? Do you have scouts that go out, or are you just super active and knowing where to go and price these? What do you do in order to come up with what you believe is a price that'll be advantageous to your investors?
Sure. So we have probably the best manager in the world. His name's Adam LaPierre. He is one of 50 masters of wine here in the US. He was previously the president of Vint, a big wine trading firm. So what's great about him is that he's not just a som. He's really focused on the business of wine, a really data-driven individual. So I'll talk about how are we sourcing and then how are we selling. So on the sourcing front, it's really a two-pronged approach where we're combining fundamental research, which for him, it's really world-class knowledge of the industry, with data from the UK, the US, and auction markets. We're taking in hundreds of thousands of data points each month to help identify value opportunities where wines may be trading at significant discounts to their estimated fair market value. I think the end state of that is something like a research terminal that we're using to research and automate the sourcing decision. But right now, we're just taking that in. He's looking at that, and then we're sourcing from negociants in France, through exchanges in the UK, and also direct from the source. So that's how we're sourcing, and I'll actually extend this to the life of the investment. From there, we're storing primarily in the UK. These are wine storage facilities, warehouses that are climate controlled, protected. We have insurance policy across all of our assets. And it's really the UK that has this infrastructure in place. It's the home of fine wine trade. So the facilities that we work with are storing, upwards of $1 billion worth of fine wine and spirits, stored, insured. And then when we think about the exit channel, we have our own licensing and our own, relationships to go and sell these assets, either to merchants or directly to consumers. Over time, the goal is evolving entirely direct to consumer because we're going to find the best margin there. And how are people finding these assets? All of our assets are listed with a certain target price, which is, double-digit IRRs on Wine Searcher, which is a wine search engine. If any of you are big into wine, you've definitely been on Wine Searcher. So people are finding our pricing, which tends to be pretty advantageous. And that's how we're exiting some assets as well as our own relationships. So that's kind of the life of sourcing, storage, managing the portfolio, and exiting.
Very interesting. There's some more questions in here as well. There was some question on the refrigeration. I think you covered that. Ashish is asking, do you have a certain percentage or a special allocation that you set aside for any wines that happen to be damaged? Like, I guess relating it back to real estate again, we have vacancy rates, right? Or bad debt collections. Do you have any sort of reserve like that in the fund, and how do you price that?
We do not. We are
Okay.
insured against that.
Okay. And let's see. I can continue to let you go with your presentation here, and we can take questions in a moment.
No, I mean, questions are good. I can jump back in, and yeah, I'll run through like 2 slides, and then if any of the questions relate, like definitely hop in. But I prefer this to be more of a dialogue than me just going through slides. It's more fun that way. Yeah, so obviously I'm biased towards Vint being the best way to invest in wine and spirits, but there are other ways to do this. You can have a seller where you are going and buying these typically at retail. You can work with a UK manager who will kind of run a separately managed account for you. There are whiskey funds that are investing in bourbon barrels out there. What I can say is that we are the only platform looking at the collections that is qualified under Regulation A+. And what that enables is both accredited and non-accredited investors to invest in the collections, but also from a reporting perspective, we provide annual financials that are audited. For us, being best in class when it comes to that inventory management and reporting is really important. I don't view that you create a new asset class without working with the SEC and FINRA. So, we have the self-directed platform. You have the fund as well, which is, for us, we have investors who like to invest in the offerings, build a diversified portfolio that way. Great for self-directed investors. We do those offerings each week. We did one today, sold out in a few hours, sold out anywhere from 10 seconds 2 weeks ago to a few weeks. But then also the fund is for people who like to just cut a check, be diversified across the asset class. Thinking about portfolio construction, obviously, I am a big believer in diversification, not only across a total portfolio, but within an individual asset class. The index here that we look at is the LiveX 100 or 1000. LiveX is a UK, I'd say, stock market for wine, where people are trading on that. We're a member. It's B2B exclusively. You can typically find really interesting opportunities to source. So that global share of trade number comes from their secondary market trade. And over time, you've actually seen a globalization of really fine wine, where if you look back at 2010, Bordeaux was making up 90% of the secondary market trade. And over time, other regions have produced really, really high quality wine that have put it on the stage with Bordeaux. And, these high quality wines, they've proven that there's a secondary market that leads to the appreciation of the underlying asset. And any sort of delta in terms of the global trade versus what we're sourcing, a lot of it's coming from the data that we're taking in. We like to find opportunities. We don't intend to match the index because we view the data and the research that we're doing to create an advantage. Here's some of the factors. I've talked about this quite a bit, but to dig in a little bit further on a few of these, production quantity that is fixed, if not decreasing. There's no more land on the right bank of Bordeaux to produce great wines. Drinking window, it's a common question that we get is, how long are these wines or spirits really good for? Is there a risk of spoilage where, it surpasses its drinking window and therefore has a big drop off in terms of price? A lot of the wines that we're looking at have 50-year drinking windows. They're really long. They're meant to age. In fact, I view us to be, in a way, getting paid kind of for the carrying cost and aging cost of these assets. Because if you think about the industry, the producer, they don't want to hold that inventory for 8-10 years when it's really drinkable. They're trying to turn it over and, produce more of next year's vintage. The negociant, who really acts as a distributor, distribution models, they are, once again, high turnover businesses. And then retailers, they don't want to hold these wines for 8 to 10 years when they are really drinkable. Neither does a restaurant. So that's kind of where we're fitting in. Is kind of, we're getting paid for holding this as well, because someone needs to. Some collectors do, but ultimately having someone like us where it's stored in bond, audited inventory audits, financial audits, is better than a collector because there's just questions around storage always when you work with collectors, which is why we don't really source from collectors, exclusively sourcing in bond assets. When we think about provenance, a lot of attention is out there on, fraudulent wine. I don't know if anybody's watched Sour Grapes on Netflix, but it's a documentary about this individual named Rudy Kurniawan, who was faking wines, went to jail for a pretty long time. And it's a common question that we get asked. And for us, our supplier network, highly trusted, long track record of, really, really high quality wines and process. And a lot of time we have visibility into, it came from the chateau to the negociant to Vint, or from the chateau to the exchange to Vint, and with it being stored in bond, original wooden casing, we're only buying cases, no real individual bottles. Feel really good about the provenance and this multi-step process that our storage partners take to authenticate.
All right, I have some questions.
Yeah, let's go. Questions.
So specifically, I'm coming at it from the perspective of, a passive investor. And if I'm looking between a couple of different types, of maybe a couple collections, maybe one's a whiskey collection, one's a wine collection. I'm curious, what you mentioned, there's a lot of inefficiency in the market, and I definitely believe that, but what would I be looking at to determine, which one would appreciate better over the next coming years? What are the pricing drivers of wine and spirits, and how should a passive person try to evaluate that before jumping into an investment?
Sure. And that's a really good question. And it relates to our investors. Like, some people buy every single collection. They just kind of want to index what Vint is bringing to the table. Our diversified fund, we take a 70-30 approach, 70% wine, 30% whiskey. Obviously, we don't provide financial advice. I can give that whole spiel disclaimer, but a lot of what we're looking at here is what the hands-on investors who are doing their own research will look at. Valuation. So what is the discount or premium to the estimated fair market value? Obviously, larger discount, they may ask questions like, how are you sourcing? Like, how are you able to acquire this at such a large discount? A lot of it comes to the data, relationships, and scale that we have. The main source of research that a lot of investors use is we put out a one-pager. It's our thesis document, which outlines, why did we source this? What are the potential catalysts? And here is just our overall thoughts on the region or the underlying assets. So I wouldn't say many people are going out and doing primary source research where they're pulling critic scores. What was the production quantity of this vintage versus that vintage? Is this a better vintage? Is this a worse vintage? A lot of that is encapsulated in this one-pager thesis that investors review prior to investing. And that's actually probably the most common question that we get from investors is like, what do I buy? Wine and spirits might be something that I like, but I don't know the best way to build a portfolio here. And I kind of gave some examples of, what other investors on the platform do. Some take a full index approach, 70-30, some just want exposure to whiskey and they did the rare whiskey fund. Wouldn't say there's necessarily a right or a wrong way, but I would say diversification is something that we like to talk about and make it really easy. We've done 70 offerings. Say you wanted to invest $5,000, you could have bought one share in every single offering and have the most incredible portfolio of wine and spirits.
That's interesting. Are there any pricing characteristics that are different between, say, wine and spirits? I guess maybe that comes to why the 70-30 approach. And And what I'm getting to is, maybe is one more price stable and one more volatile? Or do they have opposite demand curves where one might be going up while another one goes down, or do they tend to move together? What are the differences between the two pricing
Yeah.
wise?
Really, really good question again. Whiskey is more opaque. Wine has a lot more data. You have Wine Searcher, you have LiveX, which with that, transparency, I would say you're not able to find as good of opportunities because it is, more transparent. Whereas whiskey, still a little bit of the Wild West when it comes to pricing data. You have these indices, which I don't have. That's actually something that we should have, is like correlation to wine and whiskey. But we have seen the end consumer of these, which ultimately impacts the price, is of a very similar profile. But the strong demand for whiskey has been driven by more recent globalization. I kind of talked about 2010 to say like 2015. You saw globalization across the wine market with these new regions producing better wine and really just being on the stage with the best wines from Bordeaux. Whiskey, you've just seen really, really strong global demand. Japanese whiskey, Scotch. We did our company offsite in Kentucky this year, and bourbon is continuing to see international demand. So although the end buyer is of a similar profile, they don't perfectly track, and whiskey's kind of lagging, which probably why you've seen strong returns, is people are finding out about this as the globalization piece happens.
Nitin or Nitin is asking, and I apologize if I said your name wrong. He's interested. He's been looking at your website here. He says that there's a cautionary disclaimer that says, if the assets do not appreciate, there may not be sufficient proceeds from the underlying sale to repay the initial investment. And he's just asking about what protections are there. Is it purely price demand, or why do you put that on your website?
Yeah. So the SEC audits our website, and we include a lot of risk factors on the website. And this is an investment. I'm not going to tell you that it's going to go up all the time. And if someone tells you that, I'd probably run the other way, but that's just me. So there have been periods of time where this asset class does not appreciate. 2010 is a great example of this, where Asian market demand was really driving the price of Bordeaux. You saw really strong appreciation of Bordeaux. That wine was basically totally cut off as a result of like corruption investigations and fake wine in China. You saw really strong demand just go away almost overnight for these Bordeaux wines. Bordeaux used to make up 90% of the market. So that really impacted, the fine wine market at that time. So I'm not saying this always appreciates. There are times where it goes down. For us, we have the benefit of thinking over a long time horizon, such that we can ride out cycles. And with the nature of our very diversified approach, if one region's down, another might be up, which is, in my opinion, how you hedge that just general investment risk, is you build this diversified portfolio. So we've not exited any assets at a loss, but that's in place in case, all of a sudden Napa wine really falls out of favor. We've done some Napa collections. Maybe we think there's no hope for Napa, and we decide, okay, we're going to cut our losses, sell the assets at a 20% loss. That's in place, because, that hasn't happened, but it's fair to acknowledge that possibility of any investment could go up, could go down. I think we have a pretty good model, but it's in the scope of possibilities.
Okay. And Priyam is asking, How sensitive is the investment to public sentiment? Is it taste-based? I'm wondering if reviews or better vintage of the same variety or winery or vineyard could drive the value of the collection.
Yep. Public sentiment is a factor. Vintage quality, which sometimes changes over time as these wines are tasted and then retasted. They're tasted right now on Premier, which is the wine futures system in Bordeaux, which is pretty interesting. It was created around World War II as a way for producers to pull forward their cash flow of aging assets. So they have this wine that ages for 2 years, really challenging business model. So the future system was created to help these producers grow. And those wines are being tasted right now. They're going to be retasted in 2 years when they're bottled, and then also tasted 5, 10. And, you may have changing sentiment over time as they are continuously tasted by top critics. And that's something that we are monitoring. One of the most famous critics is Robert Parker. And I don't know how true this story is, but there was one wine investor back in the day who supposedly had an identical palate to Robert Parker, and Robert Parker would really drive the value of wines. If he rated it as a 100-point wine, that was going to appreciate in price. This guy would taste the wines. He's like, oh, this is a great wine, and buy it prior to getting the Robert Parker rating, and would subsequently appreciate. So there are, it is taste driven. There are other factors. One is classification systems. So a lot of regions have different classification systems, and our fourth collection was a Saint Emilion upgrade collection. So Saint Emilion in Bordeaux, they have a classification system, and every 10 years they reevaluate brands to see where should they be ranked. Prior to 2022, I believe there were only 5 wines that were ranked in the top tier of the Saint Emilion classification system. We had done our research and saw that Chateau Figeac had kind of gotten snubbed in 2012. They, in a lot of people's opinions, should have been upgraded. Over that time period from 2012 to 2021, when we sourced these assets, we saw that their wines were appreciating in terms of scoring data. They had brought on a new winemaker. They had invested to create a better product. And we took a bet that they were going to get upgraded in 2022. And they were subsequently upgraded. We saw the price of the wines appreciate. It's kind of another example of factors outside of supply and demand, such as taste or classification, driving value.
All right. And then one more question probably, and then I'm going to ask a fun question at the end. But Ashish is asking, can you highlight some of the differences between the retail collections and your accredited investor fund? Differences in IRR, hold period, what does the fund purchase? Is the fund making up for empty slots in the collections? So here, you've got the slide.
Great question. Yeah, it was funny. I was going to jump to this one anyways. Read your mind, Ashish. So what are the differences here? The collections, they're really targeted at investors who are more active, looking for a place to get started, may want to try it out and then make a bigger investment. They're structured as series LLCs and taxed from a corporation perspective. Why we do that? So the tax document you would get is a 1099 div only at the time of distribution. Why we do that is that we have thousands of investors, and sending out K1s to all of them is unsustainable. So that's one big difference here. Our model there it's a marketplace model. We only take a sourcing fee, or we look to take a sourcing fee when we acquire assets below their fair market value. They're qualified under Regulation A plus. There's 200 pages on the SEC website that outlines how we do what we do related to the collections. Whereas with the fund, and so min investment $50 to $100. With the fund, that is taxed as a partnership. You get a K1. The minimum investment is $10,000. Under Reg D, most funds are. It's the only accredited investors, and it has that structure similar to a fund with a management fee, preferred return or hurdle rate, and carry. And this was really created for high net worth, ultra high net worths who just want to cut a check and be instantly diversified. RIAs, family offices, and this fund is actually currently being onboarded on the Schwab and the TD platform, as we have some RIAs who are really interested in it.
Oh, that's congratulations for that. That's a
Process.
big thing for you guys. Probably a big process too.
Yes.
I'm curious. Under Reg D, is this a 506c fund accredited
Yes.
only? Yeah. Okay. All right. Very cool. And a couple of fun questions here. We've got 7 minutes left. Actually, while we're doing that, do you have your contact information that you could put up on the screen just so that people can reach out to you?
Yeah.
And then
Let's see.
if anybody wants to ask any questions too, feel free to either put it in the chat or I'll open it up right after I ask this question.
Yeah. Contact information, nick@vint.co. Put it in the chat. So I'm addicted to email. I will respond almost immediately.
Excellent. So I've got to ask, of course, favorite wine or wine label and favorite country for wine, and the same questions for whiskey.
Yes. So let me preface this with, and I actually view this as a big competitive advantage. I'm the least nerdy person on wine and spirits on our whole business team, because we have masters of wine, certified somms, people who are like true nerds. I don't know if I want a wine nerd who loves Napa cabs picking my investment wines. Not that I'm picking, I'm providing support for it. So, and the industry is really outdated, but I think it takes an outsider to really improve it. Anyways, favorite wine label for my wife and I's anniversary, we went to Santa Barbara, and one of our advisors is Amy Christine. She's an MW. She has a brand, the Joy Fantastic, and that is special place for me in terms of wines. Just I think experience around the wine that you're consuming is really, for me, what drives why I may like a wine and why it might be my favorite. So the Joy Fantastic, they have a few different varietals under that that label, but I'd say that's my favorite. A region that I am big on currently is South Africa. Went there for my honeymoon. Pinotage is a varietal that is exclusive to South Africa, and they're making really good wine. That wine's only getting better. Whiskey. I am personally a Scotch fan. I do not have the budget to even be close to the Scotch that we're putting on our platform. So just as a sort of broad statement, Scotch. And then I'll, in terms of favorite, I'll give you the coolest that I have is when we were in Kentucky, we did a blending experience where we got to try Kentucky, Indiana, Tennessee, a few different bourbons, and then blend our own bottle and bottle it. So everybody got their own unique blend. So I have the Nick King blend. I think that's my coolest and favorite bottle that I have.
All right, great. Fun to hear those answers. Any other answers or any other questions from anybody in the group? We've got 4 minutes left.
Hey, Nick, I just want to say thanks very much. For the rest of the group, I was introduced to Nick by a common friend, and I've been chatting with him for a couple of weeks now, debating investing through a self-directed IRA. The question, I think I posted it was, what does a fund invest in? Is it investing alongside the collections, investing in their own collections? Or is a fund making up empty slots, right? So if you're raising $300,000 in collection, you only have 250K in commits, is a fund making up the difference?
Yeah. Fund owns its own assets. It's not buying collections. It's not covering any gaps. All of our collections have sold out, typically sell out pretty fast. So they're going and sourcing their own bottles and owning those bottles. As you know, kind of through the mandate of the fund, the 70-30 approach, or with rare whiskey, a blended whiskey approach. So why we do that is, you know, if they owned the collections, there would be like a triple taxation almost, as opposed to owning the underlying assets.
Okay, and then the K1s, is it a single state K1 or is it multiple states?
It is, I will have to get back to you on that. We haven't distributed K1s as the fund product came out Q1.
It probably just K1 from the location where the LLC was registered would be my guess, but yeah. Okay, anybody else? And if not, could you guys all take yourselves off mute and thank Nick for coming in and sharing with us today about wine and spirit investing?
Thank you, Nick.
Appreciate it.
Thank you,
Nick.
Thanks, Daniel, too.
Great.
Thank you, Nick.
Yeah.
Thank
Yes,
you,
well,
Ashish,
And thank you,
for
Ashish.
introducing us.
Thank you all.
And- And next week, we are going to get back into a real estate topic. We're going to be talking about investing in probate deals. So look forward to seeing you all next week, and have a wonderful Mother's Day.
Thanks, Daniel.
Thank you.